appropriations, and I think it's gonna be mostly us. We're gonna have to do it. Okay, we are now live, and this is Senate Finance, and we are getting, I guess this is, goes in the 101 instruction category, just a walkthrough of consumption taxes, what they are, what we have. And then tomorrow we will start looking at possible ways to finance the child care bill, which I gather will be submitted. It won't come out onto the, maybe it'll be on the floor tomorrow and come to committee. We do have a third bill in here. I am setting up testimony on the salt workaround bill. But the other one is S50 came to us today, and I don't know why it came to us, because it's the same bill I submitted 2 years ago, and it went to Health and Welfare. And it's requiring hospitals that can't get you to see a specialist in less than 6 weeks be required to refer you out of network, and I don't know.
That
So
does seem like a healthcare issue.
it is. So I will talk to Senator Lyons, and if she says she'll take it up this year, then I might give it to her.
6 weeks? You've been in hospital for 6 weeks?
Not 6, no, this
You
one.
haven't been referred
Remember
to a
the guy with
specialist?
the kidney stones that couldn't get to see a specialist? And he was in agony for 6 weeks,
Like outpatient.
like outpatient, but you're part of the network. And so there are issues around
I
that.
don't remember that,
And
but it
apparent-
seems like the,
It was very painful for the person, and it is an issue. And I've worked actually with the insurance companies, and there's also an issue with getting all your medical records transferred to your new doctor. So we will, but I think that needs to go back to Health and Welfare, so I'll check with the secretary. Because it really doesn't seem like our bill, but consumption taxes are. So we're gonna start. Abby, you're here. Are you first, or it's Emily?
Yes, I'll go first with the legal overview, and then Emily will give you the full
This is money details. Okay.
So I'm going to share my screen. For the record, Abby Shepherd, Office of Legislative Counsel. Just gonna make sure this is working. Okay.
And those are the consumption taxes that we have, right?
These are the consumption taxes that I handle. So this is not going to go into gas tax or liquor taxes. This is the primary.
These are the
large
two
revenue
main,
generating.
all right.
Yes.
We don't have an excise tax, or we do on alcohol, right?
Yes,
And we do on cannabis now.
correct.
Excise tax is only in spirits
Well,
or?
I mean, in Massachusetts, you called it a luxury
General.
tax, but jewelry and fur coats, when people bought those, had extra taxes on top of the standard sales tax. I asked because one of the suggestions for funding childcare was the 15% sweetened beverage tax. But we can't charge a separate sales tax. That would have to be an excise tax if we can even do that, correct?
So yes, Madam Chair, you are absolutely correct. You are well apprised of the streamlined agreement, which
Yes.
has a lot of
Been here
restrictions.
since the beginning.
Yes, so do you want me to fold that into my, I do.
Yeah, if you can, yeah, just
That's absolutely relevant to
Yeah.
everything you're considering.
Well,
you know.
does put some limitations, but it does allow us to collect for online sales.
Do we have a national member of the streamlined sales tax?
You do not have a legislative member currently.
No, we
There are
don't.
2 for Vermont, and there's a Vermont Department of Taxes employee who actually was just testifying last week in Ways and Means. If you want to hear from the department because they've been involved since 2007, since Vermont became a member. And until 2020, I think, was the last time the legislature had their own delegate.
Okay.
Nominate Tom Junior.
It's
Yeah,
fun.
because when I wanted to change the name of that product, I happened to run into
Craig Johnson.
Brian Kennedy from Rhode Island, who was on all of those, and he was actually at an NCSL meeting and mentioned he was on the Streamline Sales Tax Board, and I said, well, then I know
Mhm.
who to tell you the problem we have. And he got the director in charge and he
Yes.
worked it out.
It's very accessible.
Yeah.
Great, well, I will dive in. So I'm going to just talk about those two tax types. And I've split it into the structure because we've been doing all these one-on-ones just to remind everyone of the basic structure of a tax. I will talk about Quill and Wayfair, and that gets to this streamlined issue as well, and marketplace facilitators, just to remind everyone of the major changes that have been happening over the last few years, because these have had significant revenue impacts. So the tax base is retail sales. So it's, you're just mentioning, Madam Chair, there's a distinction between retail sales, taxes that apply to retail sale versus excise, which are typically on wholesale distribution. They can, in the case of the cannabis tax, also be on retail sales, but that is a separate, that's more of a sin tax. But typically you're looking at excise taxes like tobacco taxes, cigarette taxes. So I also am not addressing those in this presentation. So it's a tax on retail sales of tangible personal property, and then other enumerated charges or services. Tangible personal property means goods, so things you can touch, and that includes pre-written computer software. So there are many, many exemptions that are within the code, within Vermont's sales tax code. They're based on the type of the good, the purchaser, or the use. It can also be based on the seller or the type of transaction. So there are a multitude of exemptions. I believe you've had, had the tax expenditure report in here, or have, I haven't followed all the testimony.
Yes.
Okay, so you saw the list there. So yes, I'm sorry, Madam Chair, that is correct. There are many different types of exemptions.
That one just stood out to me.
Reset casinos. Reset casinos.
Yeah, rental. Somebody's kid was going to the junior prom or somebody's wedding was very expensive. I don't know how else we got tuxedo rentals of all the rentals there are out there included in the exemptions, but that's it.
It may have been in Los Angeles, it was the airplane ticket that made it.
That's true. Okay.
There are also statutory purposes explaining all of those statutory exemptions. There's a flat 6% rate, and then the liability is on the final purchaser, which again is just distinguishes between a wholesale tax. The tax is paid by the purchaser. It is collected by the seller at the point of sale on behalf of the state. These are also called trust taxes because it is held in trust for the state and then remitted to the Department of Taxes. So I think at some point I've seen an iteration of this presentation that's called trust taxes. It is paid on retail. There's also use tax that is paid on retail sales of products whose destination for use is Vermont. So sales taxes in the state, use tax is when you have an individual buying outside of the state and bringing the product back into the state for use. It applies statewide, and then as you're well aware, there's a 1% local option tax on retail sales when a municipality has voted to impose a local option tax. I'll mention that again for the meals and rooms tax because the town or municipality has the option to impose it on sales tax, meals and rooms tax, or alcoholic beverages tax. So some have, I don't know if any town has all three, but some have it just on sales, some have it just on meals and rooms. Okay, so I'm going to dive right into Quill and Wayfair and the ways that the sales tax revenues have been increased over the years. I'm sure many of you have encountered this. It has been a significant revenue increase to the state. So we taking a really big step back, looking at the constitutional limits to a state's power to tax. The Commerce Clause is a relevant constitutional provision that reserves to the federal government, Congress, the power to regulate trade or interstate commerce among the states. And that Commerce Clause restricts the state from taxing goods in interstate commerce in a way that discriminates against interstate commerce. So we had a discussion the last time I was in here about not discriminating against out-of-state individuals. You can't treat them differently than you would treat Vermont residents, but that also applies to interstate commerce. That is preempted as a federal area of regulation, so the state cannot burden interstate commerce or discriminate against commerce that's between the states. Also, the Commerce Clause and the Due Process Clause is not imposing an undue burden on that interstate commerce, and that became very relevant to Vermont's membership in Streamlined. And I'll get to that. In 1992, so pre-internet, there was an office supply company called Quill that was soliciting and selling goods in North Dakota via US mail, pre-internet, but Quill had no physical presence in the state. North Dakota sued Quill, the company, to collect and remit use tax on the goods that were purchased for use in the state. And under the Commerce Clause, the US Supreme Court ruled a state cannot force the seller to collect and remit if they aren't physically present in the state. So this created the Quill rule that meant an online retailer, once you have online sales, in this case it was catalog sales, when retailers lacked a physical presence in a state with a sales tax, they did not collect and remit. And that was the state of the law until 2018. Online sales increased 1992 to 2018 significantly as a proportion of all sales. Sales and use tax revenues to states were declining, and the policy concern behind this change is that online retailers were not collecting and remitting sales tax and were getting a competitive edge over retailers located in the state, brick and mortar retailers. So South Dakota enacted a law in 2016 that directly challenged the Quill precedent and required any vendor, regardless of their physical presence in the state, to collect and remit sales tax, and they created a threshold for small vendors. So if a vendor annually delivered goods or services into the state that exceeded $100,000 of sale or 200 or more individual transactions, the vendor would have to collect and remit. Online retailers, including Wayfair, they got their name on the case heading, sued to invalidate South Dakota's law. So it went up through the South Dakota courts and ended up being taken up by the US Supreme Court, which did rule that in light of subsequent developments, the internet, the physical presence requirement in Quill was considered incorrect and unsound. And they concluded that South Dakota's economic presence test did not create an undue burden, so that gets at the Due Process and Commerce Clause issue. Because South Dakota did exclude smaller vendors, so those with that $100,000 or 200 transaction threshold. The court also specifically pointed to the Streamlined Agreement. South Dakota is a member, was at the time, I believe they still are a member of the Streamlined State, which is the multi-state sales tax agreement, which reduced the compliance burden on sellers to comply with the collecting and remitting requirements. So the takeaway from Wayfair, in part, there were several takeaways, but the sense of a clear safe harbor, provided that a state has a similar economic presence threshold. So that's not placing an undue burden on interstate commerce, particularly small sellers.
Does this seem like settled law? I mean, given everything the Supreme Court is kind of throwing back up in the air, does this feel nonpartisan in any way at this point?
It's certainly precedent right now. It's certainly possible as well that the federal Congress could take action and enact some sort of law that precludes states from collecting. Between 92 and 2018, there were constant proposals of laws introduced to do that, and they never passed. So it's possible the landscape could change, but there's nothing currently that would change this.
Was Wayfair a 5-4 vote, or was it unanimous in the Supreme Court?
It was not unanimous. I don't remember exactly, but I think there were only 2 dissenting justices, but I can check. 2 or 3. It was a pretty clear majority.
Considering that we are a state that is a lot less dependent on sales tax than many others, now that the states have this revenue, it might be a little harder to take it away. One never knows.
The question today is which two justices?
I know, exactly.
I can check. I'm sorry, I don't want to do this. Vermont did anticipate Wayfair. Again, there have been multiple challenges. So in 2016, which was when South Dakota enacted its sort of challenge law, Vermont enacted an economic presence threshold that was identical to South Dakota's. So $100,000 of sales or 200 transactions in the prior 12-month period would trigger a collection requirement. It was not enacted, well, it was enacted, but it was not effective immediately. It was made contingent on either Quill being overturned or federal legislation. The term was abrogating, so superseding the precedent. So the date when it actually took effect was within a week, I believe, of the Wayfair decision being released. So it became a requirement in Vermont for sellers when they were over that $100,000 of sales of 200 transactions to collect and remit. So starting July 1st, 2018, Vermont has had that law on the books, and it has been effective. So that's really important to emphasize as well, that Vermont is a member of Streamline. Streamline was specifically noted as one factor to show compliance with or being within the limits of the Commerce Clause and due process, so not placing an undue burden on interstate commerce.
And basically, the argument was, you've got 50 states, they all have a different definition of soft drink. They all include some of this category, but not all. And that if we're gonna do it, it's gotta have one definition. You can have different rates, but you've gotta have one definition essentially.
So that's wonderful you just brought up the rates, because Streamline says you can only have one statewide rate. You can also have a local rate, but you can only have a rate or zero. You can either exempt or you can have one rate. You can't have multiple rates because that would also increase the complexity, particularly in states where towns have much more authority. So municipalities can enact their own taxes, and they could set different definitions and different rates. So Streamline limits that to reduce compliance.
New York used to have regional rates. Because there were like, in upstate New York, there were like 3 or 4 regions, and depending on where you were selling, it was a different rate. I don't know if that was locally imposed, but it.
Right, because there are also county taxes.
Yeah.
So it gets very complex.
I paid it to the state, and it depended on where I sold things, what the rate was. But it was different.
I think we can relax about the decision. The decision was 5-4, and those in the majority included Thomas, Alito, Gorsuch, and so on.
Maybe.
I'm surprised the liberals are opposed to tax.
Yeah.
Opposed were Roberts, Breyer, Sotomayor, and Kagan.
Different. Okay.
Forgive me for such a basic question, but I've been off this committee for several years, and I forget. The sales tax, who are we actually taxing, the buyer or the seller?
The buyer.
We're taxing the buyer, okay.
And some of us, I think you weren't here, collected, are responsible for it and pay it to the state with no reimbursement. And we get fined if we don't do it correctly.
We get to use the streets though, don't you? Isn't that your thing?
What is cheats?
The streets, the money, while you have the money.
I mean, the massive interest I earn in checking account.
Do you have more slides?
I do. Many.
I have questions, I just don't want to.
I was going to move on to talk about marketplace facilitators. If you still have questions about remote sellers, this is actually part of that. It's the expansion to another type of remote seller.
It's the next step.
Do you want me to frame it now? So I would love clarity on the local options tax that some communities have in the state of Vermont, and how easy or is it not easy for when a community enacts one, and for Amazon to enforce? Like, is it relatively easy if Jericho would put in a 1% options tax for Amazon to then systematically then know to collect the 6% rather than the 5%? And is our system currently enabled, as far as you know, to be able to identify that 1% to then be attributed to the municipality of Jericho, to which it would be earned if they were to execute such a thing?
Yes, so it would be 7%. So the state
Right,
rate
sorry,
is 6, and then you add 1. That is based on zip code data, and there are software filing companies that do that. However, there has been, this has come up as a big issue, particularly with the town, and I get it wrong, I apologize. I think it's the city of Essex Junction, it's just created, thank you. So there's confusion between two. So they share the code and how to delineate deliveries, particularly to individuals in the municipal option tax. So I know that the DPW has a proposal to get at that data to require refunds, but that's sort of pending.
The software does work. I know, for example, I live in Swanton. My mailing address is St. Albans. St. Albans town has a sales tax, and Swanton does not. And I look at my bills carefully, and it does work. It's able to differentiate which is which.
Yeah, so it's based on the zip code, but if the zip code is the same, there is some challenge there for the sellers and when they're using software to comply with that.
It gets down really to the undue burden. If you just have a computer run a zip code, the computer can change the amount. But if you have to have a human sit down and look at a map to differentiate that.
One of the problems that I've seen, and I think I may have mentioned it before, I've certainly mentioned it to the commission, is we had in one case a vendor, Tractor Supply. And Tractor Supply has a warehouse store that is located in Swanton, just literally feet from the line to St. Albans town. And for a period of about 5 years, they were charging St. Albans town sales tax, thereby overcharging all of their customers by 1%. Customers had complained, the store did nothing about it. I sent a note to the commissioner, and 2 weeks later, it was fixed. Obviously, they can't tell me what they did, they can't tell me what they collected, but now they're charging 6%. The issue, though, is for 5 years, they're charging 7%. If I take the average volume of dollars that are spent in a Tractor Supply store and multiply it by 1% over 5 years, it's $500,000. That somewhere, assuming they collected the taxes, and I don't know whether they in fact did, consumers from our area were overcharged by that amount. And Tractor Supply has done nothing to reimburse the commuters. And so that's a discussion I've been having with Commissioner Bolio, is we need some mechanism to deal with a situation in which someone gets a, because what happened here would be, assuming that the Tractor Supply paid the tax department has a process that would allow them to refund the money to the store. The store has an obligation to refund it to its customer. There's no indication that they've done anything or that there's any mechanism to make them.
And we had the opposite come up when the Bart Mulch deal, where they undercharged people because they weren't charging the sales tax on Bart Mulch. And then there were wedding caterers and there was rooms and meals. And they're saying, but we have no way to collect it from the people that bought our stuff, because by and large, we don't know who they are. So the dealers were on the hook then and off the hook there. And I don't, unless we require everybody to submit D, and probably would fly well. But it on these consumption taxes, because you have non-government people collecting and maintaining them without any real record keeping, except what's non-sales tax, what I don't charge tax on and why, if I'm ever questioned. There's an inherent problem in identifying who did pay that tax. And if you think of a solution, Liz.
I have a solution,
Oh, okay.
and I've written to the chairman of the Gardeners of the Tractor Supply. We'll see when I answer, I guess.
Okay, but I mean, in general, is there a way we could, when these things pop up, limit?
The second part of that question, we have the existing capacity. If communities were to start tacking on the 1%, that it's the existing capabilities to, as a state, receive that from Amazon and route it to the towns at little to no additional expense or administrative cost to the towns and communities, because we already do that with many towns.
Yes, there is an administrative fee for the local option tax.
That's already,
For the state.
Yes.
You would
the
have
municipalities.
trouble with a town like Callis that has, I believe, at least 3 and 4 zip codes, because it's kind of big and sprawled out, and different post offices service it in different sections, so that might not work. Or Berlin that has no zip code. It's either Barry or Montpelier.
Well, I think about the voting here in Vermont, where you have a town that has multiple zip codes for people with addresses, but the post office is able to know which town it's in, isn't it? I mean, we certainly are able to do it on the voting file.
Yeah. Oh, yeah, no, your address is the town.
Yeah.
But your zip code goes by which post office district you're
The
in.
zip code though tells also the zip +4 tells you physically where you're located.
Oh,
So
so you
you can
did the
plot it on- You
+4,
can plot it on a map.
yeah.
If you have the +4.
Yeah.
The zip code alone does not tell you what town.
But if you put in an address, street address, there's a post office as an app that translates that into the zip +4.
Okay, yes, the post office.
Do little rural ones,
Yeah.
just the big, the post office.
So,
Rural.
No, nothing goes through, they just ship it down to White River, ship it back here. You don't just put it in the mailbox in Montpelier and Montpelier delivers it. It all goes to White River if White River hasn't been closed. But it goes somewhere and comes back.
So something like Manchester, New Hampshire, or Springfield, Massachusetts.
I think it might be. It was one of the reforms that so helped the post office in the last years. Yes, okay.
It used to be overnight with all that.
Beyond Wayfair, within 1 or 2 sessions of Wayfair being passed and Vermont's contingent effective date kicking in, so Vermont could collect from remote sellers, another issue arose that marketplace facilitators were not being required to collect and remit for indirect or facilitated third-party sales. So I have the example of Amazon, because we're all familiar with them. They do have third-party sellers using their platform. There are lots of different platforms like that. These types of sales can be the majority of an online company's sales.
eBay and Etsy.
Correct,
Oh.
yes, all those well-known platforms. So under the language that was triggered by Wayfair, that those sales were not being captured. So Vermont responded a year later to enact the marketplace facilitator law. It imposes the same collection requirements on facilitators as those that are directly applied to remote sellers. It's the $100,000 of sales or 200 transactions in the prior year. And facilitators are required to collect on sellers' retail sales and to remit the Vermont sales tax.
And that's state by state. So with those vendors, they have to keep track of which states they own.
Right. So it does sort of push it up the chain of, there might be small sellers making sales into Vermont. Maybe those sellers aren't hitting that threshold, but because they're selling through this larger platform, the platform is required to
The
flag.
platform's required.
And trust me, if you click on something on one of those platforms, within 30 seconds, you have 5 advertisements asking you to rethink and relook at those products you looked at and others. They have very sophisticated computer systems.
So that concludes the sales tax portion. Now I'll move on to the meals and rooms tax, going through the same structure. So the tax base, doing meals and rooms, so you have both taxable meals and taxable rooms. So it's occupancy, rent, or taxable meal. There are definitions for these. And again, there are exemptions based on the type of the meal, the type of purchasers or use. It is a flat rate for meals and rooms. I'm not getting in the weeds here with alcoholic beverages tax, which is also in the same chapter. That's a 10% tax. The liability does fall on the occupant or the person consuming the meal, so the final purchaser. It's similar to the sales tax. It's the final retail sale. Sorry. So the tax is collected, again, it's a trust tax because it's collected on behalf of the state and remitted to the Department of Taxes. It's collected by the restaurant for meals tax, for the operator for rooms tax, and is at the point of sale, applies statewide. And again, there are municipalities that have voted to approve a 1% local option tax. And as the discussion about refunds, it's similar for meals and rooms tax as it is for sales tax. The department can refund to the seller, but the seller must show that they refunded the purchaser. So really, because the tax is paid by the purchaser, it has to be shown that the purchaser has been refunded.
Could you explain the distinction between restaurants that, could you?
Complicated, yes. So I tried to summarize it in this slide. There are different rules for restaurants and businesses such as grocery stores that sell. So typically grocery stores are exempt, but there are different rules if they have a snack bar or a salad bar.
And then there's Senator Maz's ice.
And independent facilities that have independent living that also offer restaurants. Have restaurants and put a defibrillator on the wall.
He's just concerned because there are major restaurant chains operating in some hotel, some hospital cafeterias, right? Isn't that the test?
Well, Wake Robin is the one that comes to mind.
Wake Robin.
Is it, or the other
So there are three, I've
such restaurant?
split it out in 3 different ways because any food or beverage sold by a restaurant for consumption on or off premises is considered a taxable meal. And there are these other 2 categories, but getting at your question, there are very specific exemptions for hospitals and very specific types of what I think is statute are called nursing homes. There are different definitions though, so I don't know exactly which communities that would apply to. If it would apply in the case of Wake Robin or another
The word is,
community like that.
and I don't know that it was even in Vermont, but that in some of the larger hospital complexes, that there was food, you went downstairs, it was like a food court, I gathered, with several commercial chains operating a little booth there. And
Visitors and guests and employees that went down
or
to,
the general public
The general public.
and eat there.
not just patients.
Right, I'm pulling up the definition, so I don't just shut this presentation down. I'm not sure I will give
think
much
we ever found a
clarity.
solution to that.
So it's prepared and served by the employees, volunteers, or contractors of any nursing home, residential care home, assisted living residence, home for the terminally ill, therapeutic community residence, and there's a definition under Title 32, or independent living facility. However, contractor excludes meals or alcoholic beverages provided by a restaurant. When those meals or beverages are not otherwise available generally to residents of the facility. I'm not sure that. I don't think the existing one necessarily gets at the.
I was
Sorry, I was
I
reading
wasn't
the
getting all your
section.
words.
But that was an issue that has come up in the past, and I don't know. But senior living, frequently you pay a monthly fee. Wake Robin is a world unto itself because it has a nursing home included in that monthly fee, whether or not you use it. But you were charged a monthly fee and you get at least 2 meals a day if you've got a room with a kitchen, and it is included in your rent. And this excludes that from
From a taxable.
the taxable. I guess the question is, do you step over a line when it is being, there are several restaurant chains and you can go down and pick if you want to eat with one of those chains, and we haven't, I don't know that that's actually happened in Vermont, but it has come up in here.
My experience was when my aunt was in an independent living facility where she had an apartment, she had a kitchen, she had, she could either use the kitchen or walk 50 yards down and go in through a cafeteria style line and pass a cash register and take her nephew's walk and like brother or something and order a meal and have it show up on the cash register. And is that, in Vermont, would that be taxable or not taxable?
As long as it's one of these facilities that's listed, it would be non-taxable.
It's
I'm
charged.
assuming it sounds like it does fall within those definitions. Those are exempt.
Yes.
And they're exempt because the folks on this committee and our colleagues thought that that was a good idea.
Presumably, yes, if it's in statute.
So I would say, Madam Chair, you live in a trailer and once a week you go to McDonald's on Saturday night to have to jumbo cheeseburger meal. You pay a rooms and meals tax, but if you live in a comfortable apartment in such a facility here in Vermont, and you go down to a restaurant where they present the meal on the cafeteria line and you pay for it, you're exempt.
Mhm,
That is, I think that's a fair characterization of the current state of the law.
it is. Okay,
So why do we have this distinction?
Because you're not eating out, you're eating where you live.
Excuse me?
You're not eating out, you're eating at your home.
it's a service provided to you.
And if you're feeding your nephews, you're having guests for dinner.
Mhm. My mother is taking me to be a guest for dinner. We can check on that, but
There is a statutory purpose, since it is enacted in the statute, in the Meals and Rooms Tax.
it's right, we have to do that because it's an
Yes.
exemption.
The purpose is to reduce the overall costs of healthcare and senior care in Vermont.
So when you have your nephews come in, there's no health care cost there.
Well, it's her mental
And
health.
when you don't cook your own meal in your own kitchen in the facility that you rent,
Sorry, I found another one because there are two exemptions. There's also one for continuing care retirement community, and that is to exclude meals prepared in a person's home from taxation, which goes to 7. Sorry, was I not loud enough? Sorry.
And it is your home.
Yes, for that particular exemption, it's considered eating in your home.
I would assume that a boarding house, it would be considered, you pay rent and part of what you get with your rent is 1 or 2 or 3 meals a day.
Yes, because there is an exemption for student housing, rooms furnished to an employee of a hotel or restaurant, summer camps, those are all the various exemptions.
Yeah.
so
Okay,
I was sticking with the Wake Robin example, and the independent living example where they had a restaurant on premises. The rationale, this was in Pennsylvania, so the rationale was that they had a defibrillator on the wall.
we do too, but our meals aren't tax exempt.
It was,
We're falling down.
Pardon?
We're failing, we should exempt our meals. Could go the other way. Guilt. Some of us have a 4:30 meeting, actually, most of us, so we're gonna,
And
this
there's
one we
also-
failed to resolve whenever we took it up
Oh,
some time ago.
but not because of 4:30.
No,
With current state, we don't tax in that Wake Robin example.
right.
Okay.
Or in Westview Meadows, or in any of the assisted living, senior living, where meals, in most of them have communal meals. But you have a little kitchenette if you want to make yourself a cup of tea and a cookie at midnight when you're reading a book or something, or you don't like their meal. So, and it probably would just be difficult to keep track of the twice a year your nephew.
Maybe we use the clock down there for the meals.
I bet. She up in the Poconos and
No, I'm down
oh, there's my clock. Okay.
So I have listed out 3 categories of when a meal is considered taxable. It's based on whether it's sold by a restaurant or not. I mean, that's where you get into a lot of the exceptions to the exceptions. So if it's sold by a restaurant, it's always considered taxable unless there's an exemption. If it's food or beverage not sold by a restaurant and not prepackaged, it is taxable if it's for consumption on or off premises. And then regardless of where sold or whether or not prepackaged, there's this list in statute: sandwiches of any kind except frozen, food or beverage furnished from a salad bar, heated food or beverage, and food or beverage sold through a vending machine. Those are always taxable. The food or beverage sold through a vending machine, I think, is the most recent. I think there was more of a compliance issue or confusion around that. So that was added in, I think, around 2015, maybe. I'm sorry, my memory fails me on that.
Okay, so yeah, it got to, if you bought a bag of potato chips and took them home, they weren't taxable, but if you bought them to go with the sandwich you were eating in the restaurant, even if you were taking the sandwich out, which the shopkeeper trying to figure out where. And ice was, if you buy ice to put in a cooler, I guess it's taxable, but it also can be a food or beverage. That was Senator Mazza's, and he said of the storekeepers, it's a 50-50 split as to whether or not they tax. For the record, Commissioner Bolio says it is taxable. But, yeah, you get ice in your drink, you don't. I guess you don't pay extra for it. But that was, that one, this section has probably caused more audits and more confusion. Because again, it has somewhat of a use base. It's, if you're going to eat it on premises, but a lot of places do take out and eat in, and it gets,
That's got complex.
it
A lot of
gets to
definitions,
be a
but
judgment area, and
this does not include all of the exceptions.
yeah.
Moving on to rooms tax. A taxable occupancy is rent. So room tax is due on the rent charged for the use or possession of sleeping accommodations that are offered to the public for a consideration. So for a charge does not include occupancy by a permanent resident, so an individual living in a room for at least 30 consecutive days, does not include an employee of an operator when that's part of their wages, or an occupancy provided in a summer camp for children. And I believe this is not an exclusive list of, I can check.
I don't know if you were in the room with the timeshare presentation, but timeshares with annual maintenance fees are usually less than 30 days, and you're paying thousands of dollars to maintain access to that. Are they charged a rooms tax when?
Don't believe so, because they have an actual right to the room. It's not, not a charge in the sense for rooms tax. Because that's in the property tax area. They actually have, that might be specifically noted in here. I can look and get back to you on that. I think there might be an explicit exemption for a timeshare.
Yeah, because they own
Yeah, their actual.
The ambiguity that was presented to us, it's increasingly like that it's a
Yeah.
hotel experience when you have these
Yes.
points that can be used all over the world, that it
Right.
seems.
But if I think, yeah, we may need to update the law to get in points, but you are paying something. So it's a rental, but the timeshares is actually an ownership. So there's no, it's one of those fish and fowl things.
It is explicitly called out in the definition of rent. It says, money received shall not be considered rent and thus not taxable if a deeded interest is granted to the purchaser for the timeshare rights. So you're correct, there is overlap, but it was explicitly excluded in statute.
There are these programs where I've gone to the sessions and yes, they're ostensibly buying an interest in a specific property, but their selling point, because I've gone through like 6, dragging my wife along to a few of them, their selling point is that you buy a ton of these points that can be used all over the world. So when those points are used to stay in Vermont for a property interest somewhere else, are they paying rooms tax on the value, the market value, or the transferable value of those points?
If it's not a deeded interest, perhaps, I don't know under that, how that
Yeah,
definition is treated.
at,
Points.
this may be one of those new things that we just, until there's a court case and,
But I'll let me look into that, because there's also issues around like gift cards and how those are, whether, at what point the tax applies. So I can
yeah,
see if there's any
and it's,
guidance in that regulation.
I play these points games and I have
okay, do you remember the name of there's one big one, I know they're buying out places in
RCG, Wyndham is a big one.
Wyndham. It has a Vermont name sounding connection,
Starwood preferred guests.
okay. I mean, because I can sell up for any kind of a hotel and get points. You get a Hampton, well, most of them are owned by corporations that own multiple chains, and you get points in any one of them. You don't own a right, and I'm not sure how if Wyndham's actually sell you it'd be something to look at. Because they are definitely becoming more, along with cash back for your purchases. Those are all new things we haven't figured out if they are a way around taxing. Am I refunding you your sales tax amount? I mean, your credit card gives you points, and you get, for every purchase, you get a certain credit, or some of them you get cash back. Be interesting to look at.
I don't know how much time we have. I'm wasting your time.
No, we've got 15 minutes.
So I'm a Costco fanatic. I'm known in transportation to be making a lot of Costco jokes. I shop just about there 3 times a week. I walk
My
in.
husband only goes once.
Okay.
I
But
have
my,
a year's supply of toothpaste.
what I love about my Costco card is they write me a check at the end of the year. And so I'm getting a check for a good sizable amount of money, and I don't think I pay taxes on it. I don't necessarily want to, and I don't know why I'm raising
Get a
this,
check.
but yeah. But
I've been there since the
Called
beginning. I've never gotten a check.
But it ties to the points piece. I also play the games where I get hotel points. I use points all over the place. I don't know if I'm paying rooms tax, and a lot of these new timeshares are really optimizing that.
Okay, that might, I think it may be something to look into.
So the classic example are airline points
Yeah, they tax
that you pay, in which you can, with airline points, cash them in, and you can get an around the world trip worth $14,000 or $15,000
Yeah.
that you paid for by points. There's no sales tax or whatever on the aircraft receipt.
You pay for that when you buy your tickets.
Well, when you buy
The
whatever it is
result
you
in-
bought as an underlying product, theoretically, but you could buy that anywhere. You could have bought that overseas, which I did in a lot of cases, but then I came back here and I made an airline purchase here for the round the world or whatever. And there's no tax.
There is treatment that's explicit under the regulations from the department for discounts, coupons, and gift certificates. Discounts are simply reductions in the price of taxable meal or rent. I don't know, maybe I should just peruse this and then I'll get
But
back
you
to some
can,
The only thing I suppose about me is the statute of limitation is passed.
Right, so there's a year.
but I mean,
Yeah,
people, you can save up points. And if you travel for business, then you are allowed to keep the points. I have family members that can go on vacation and the room is free because they have enough points to cover the,
Buying the points outright too. So if people are buying the points to avoid paying the rooms tax.
okay, that would be something, yeah. We'll look at. Okay, and we have 15 minutes and
There's also Emily.
And
I don't
Emily is
think
still
all of
here.
her time. I would be happy to.
I'm assuming Emily is
Yeah.
still home.
Should I stop sharing? Do you want me to go through the last few slides?
Let's do the last few slides really fast. We will all
Yeah,
be
so we're
quiet.
almost done.
See what we get with you.
There are, I have also included the definitions of operator or hotel, produced through these, although it is important for the short-term rental landscape, as that has also been a big discussion over the last 5-10 years. So a hotel explicitly includes in statute short-term rentals now, it didn't prior to, I think, 2018. I have some information about the public agreement that Airbnb entered into with the Department of Taxes of 2016. They collect on behalf of all of their hosts. There's one rooms tax license number. So it was 2018 short-term rental was added in to make it clear that a hotel includes a short-term rental, so taxes due on those rooms charges. There were, I think this is my final slide. Yes, okay. So there were also changes to the definition of operator in the last 2 bienniums. Online travel agents or booking agents were added to the definition of operator to make it clear that they are required to collect tax on their charges for booking rooms. In a similar fashion to that expansion of operator, online taxable meal facilitators were added in 2021. Also, meal delivery charges are taxable.
That was what I pay that's taxable, not what the operator pays Burger King when I have Uber Eats deliver my hamburger.
So it's what
The
the
entire cost that I pay in it. Expedia was one.
That's correct.
All of those help you book things. They get a cut and it's the final bill that is taxable.
Okay, so that's similar to some of the sales tax changes. And I will
We gave you something to work
answer
on.
some of your questions and I'll
Right.
pass it over to Emily.
Okay, Emily, are you still there? There
I'm
she
here.
is. Hi.
Good to see you.
How's your little boy?
What?
How is your little boy?
Oh, he's great. He's
Good.
much better than he was last week. So we're all in good spirits here.
Good to hear. Okay.
Yeah. But I can do my presentation pretty quick. Let me share my screen. So for the record, Emily Byrne from the Joint Fiscal Office. All right, let me make this bigger. Can you see this well? There we go. How's that?
There, good. That's good.
Perfect. Okay, so I'm just going to do sort of a high level overview of some of the numbers around consumption taxes and kind of go into thinking about the principles that I've come in and talked about in terms of formulating a high quality tax system and what, how to lay those over the 2 big consumption tax, meals and rooms, and sales and use that Abby just talked about. So some of these things I'll go through pretty quickly because Abby did a good job of going over them. But again, 6% sales and use tax, 6% on retail sales of tangible personal property. I know Pat Titterton from the Joint Fiscal Office has been in to talk about the tax expenditure report, but just to recall, there's over $300 million worth of tax expenditures from the sales and use tax. Or there was 300 million in 2021 is what our estimate was. Just The difference between an exemption and non-tangible personal property is the exemptions are things that we've excluded from the base. So medical products, groceries, clothing, etc. versus non-tangible personal property means things like services. So we do exempt services. They're not, Vermont does exempt services. They're just not considered personal property. About 20 municipalities have a 1% local options tax, and recall that 100% of the sales tax is dedicated to the education fund, and that was changed in 2018. The chart on the next slide, so on slide 4, is the sales tax collection since 2005. You can see some of the jump associated with Wayfair. There's the change. It was split between the education fund and the general fund until that change happened in 2018. And then you can see these sort of the lighter colored green bars at the end in 23, 24, and 25 reflect the consensus forecast that was adopted by the emergency board in January, it is still January, earlier in January. And you can see there's kind of a dip in 24 to reflect what the economists have put forward in terms of that sort of soft landing and potential small recession that's headed our way. Then it kind of bounces back in 2025. This table, just for reference, I think it was in one of my previous presentations, but just a comparison of the state sales tax rates. I underlined state only because there are local option taxes in places like Vermont, and we know that New York State has lots of local taxes, it was alluded to, county taxes and municipal taxes that make their actual sales tax rates higher than what the state sales tax rate is. But as you can see, Vermont is kind of in line with its neighbors. Of course, the big exception being New Hampshire, that does not have a sales tax. And then so similarly, meals and rooms tax, 9% charged on prepared food in restaurants and bars. Tax expenditure report, there's 8 exemptions, about $10 million was estimated of tax expenditures in 2021. The rooms tax, same deal, 9% on rooms, excludes meeting rooms and hotels. And the tax expenditure report there are about 6 exemptions, but they are difficult to estimate in terms of what the actual impact is. Things like summer camps, we don't really know what the rooms tax would be if it was applied to summer camp. So we don't have a good estimate of what those are, but we outline what they are specifically. There's also the 10% alcoholic beverage tax for alcohol served in restaurants and bars. About 25 municipalities have a 1% local option meals and rooms tax. Except Elmore is a little funky. They only have a rooms tax. They don't have a meals tax, and Burlington and Rutland had their own local option meals and rooms tax prior to the sort of statewide approach to it. So they collect and administer their own meals and rooms tax. The meals and rooms tax itself is split between 3 different funds. So 69% goes to the general fund, 25% goes to the education fund, and 6% goes to the clean water fund. I have a chart that was similar to the one for the sales tax for the meals and rooms tax. Excuse me. And same, the shaded bars at the very end are the consensus forecast. And you can see the change for the split between the education fund and the general fund happened in fiscal 2019. The clean water fund came online in 2020. And that's what the green bar is. And then you can see that the meals and rooms tax was impacted pretty significantly by COVID. But has bounced back to kind of where pre-COVID trajectory. Excuse me. And again, so similar table comparison of Vermont's meals and rooms tax to the other states in the Northeast. And I think from this, you can kind of see we're within the ballpark of our neighbors. We're higher on the meals tax, but on the rooms tax, I'm kind of in the same neighborhood as the rest of the Northeast. Again, Abby touched on this, but I did not prepare anything to talk about other consumption taxes, but just as a kind of reminder, right, we've got the excise taxes that you touched on a little bit. There's also healthcare provider tax. and premiums taxes, which are considered consumption taxes, and then just other ones, fuel taxes, the solid waste franchise tax, and some of the electrical generating taxes, which we could do other presentations if you wanted to get into those in more detail, but they are a much smaller piece of the revenue pie. So I figured I'd just do a quick overview of thinking about these taxes and the sort of 6 principles that we've talked about of a high quality tax system. Here's just what those 6 principles are, and I'll run through each of those and kind of apply each of these principles to the meals and rooms tax and the sales and use tax. Just some important things to think about, and I think it's a good framework before the conversation tomorrow about the potential use of sales tax in funding of childcare. So the first principle that we talk about is this idea of sustainability and reliability, and how reliable and sustainable are these revenue streams when it comes to using them to pay for ongoing expenses. So the sales and use tax, historically, if there's a recession, you might see a dip in the sales and use tax because people's incomes change and their ability to buy things is impacted. Right now, we see that there's, while the inflation is a challenge in the economy, it does mean that prices of things are going up, which means tax collections are going up. So until it sort of catches up in the budget, you start to see increases in sales tax receipts when inflation happens. There's also demographic impacts in the sales and use tax. So as our population is aging, older individuals are more likely to use services than their younger counterparts. So that may impact the sales tax in the long term, just in terms of what people are consuming and how the consumption is shifting away from things that are taxed through the sales tax. And as well, there's just this continued shift to a service-based economy. So the sales tax doesn't generate as much as it used to because those services are not subject to the sales tax. Similarly, on the meals and rooms tax side, tourism is a significant driver of meals and rooms tax receipts. It's estimated that's about half of the meals tax revenue. And vast majority of the rooms tax revenue is generated by tourists. Often what we think about, like in terms of how is the meals and rooms tax performing, the question is, comes to like, well, how is the ski season? And are people, is it snowing in Boston? And if people are coming up from Boston, then the meals and rooms tax will benefit from that. How were the leaves this year? And did people make the drive to come look at them? And those are the things that kind of impact the meals and rooms tax. There's really nothing that we, as policymakers necessarily can control when it comes to meals and rooms tax receipts. And then COVID is a good example of, a situation where something completely outside of, anybody's control impacted how those receipts came into the state. The next principle that we think about is fairness. So how fair are the consumption taxes? Consumption taxes are always the sort of thought of as one of the more regressive types of taxes from a vertical equity perspective. So meaning that your younger and lower income households tend to spend a greater share of their income on goods, meaning that they're spending a larger share of their income on the sales tax than folks that don't. But from a horizontal equity perspective, the tax rate itself is 6% regardless of your ability to pay. So everybody's paying the same rate, no matter what their income is. Vermont policymakers have recognized the sort of regressive nature specifically of consumption taxes, which is why there are so many exemptions in the sales tax specifically, to try to account for what are goods that lower income people may be purchasing more of, and how, if we exempt them from the sales tax, does it effectively make the sales tax itself more progressive? When that happens, though, you start to come into conflict with the next principle of simplicity. And the conversation that you all were having about ICE is a perfect example of how these sorts of starting to tweak what is and what isn't out of the base can become very complicated very quickly. So as the streamlined sales tax agreement starts tries to help with some of that. We joined in 2007. There are 24 states that are part of it. Standardizes some of those definitions. And I think, a good example is candy, which means you can read the definition here, but I would like to point out that it means like something has to not include flour. So often there are pieces of candy that are considered that you would think are candy, but they include flour, which means they're not considered candy. So if you're making a decision about whether or not to include or exclude candy, thinking about those definitions and how it sort of complicates pieces of the sales tax. And then, the definition put the definition of tobacco in there because it's just another example of, this is what we follow. And then you can have some final point of sale complexities as you add exemptions into the sales tax code. So for example, if a contractor buys lumber for a house at Home Depot, are they the final consumer, or is the person who is paying the contractor the actual final consumer? And making sure that in the sales tax code, that's the actual final consumer who's intended to pay the sales tax is the one paying the sales tax. A good example, so this is directly from the Department of Taxes website, but this is what clothing is considered taxable and what is not, just as an example of sort of some of the complexities here. And the one that I like to point out is really the first one that's taxable. So if you buy a belt buckle that is not attached to the actual belt, it is considered taxable. But if you buy a belt that is attached to the belt, the buckle is attached to the belt, then it's exempt from the sales tax. So really just like thinking through all of those nuances and how they impact how businesses will be able to implement the sales tax and to keep it simple for them. The fourth principle that we talk about is economic competitiveness. This one is the sales tax is a good example of this coming into play with cross borders and New Hampshire. Our rate is similar, but New Hampshire has no sales tax. So are people making decision? How does that make us competitive in the business landscape? Having New Hampshire as our neighbor. And it is difficult to compare across states because everybody exempts different things from their sales tax base. So just look at rates and receipts. Doesn't always tell the whole story because you don't know what's in and what's out without diving deeper into their sales tax code specifically. Meals and rooms, to the extent we have similar rates to our neighbors, makes us pretty economically competitive. And states and cities have, varying lodging rates, like New York City and New Orleans are sort of known for their higher.
We're gonna have to wrap up because I've got a couple chairs need to go to a chairs meeting.
Great.
And I've got two others that are at some other meeting.
I think I have 3 slides left.
Okay.
I can go quick. Tax neutrality, right? So thinking about the sales and use tax and whether or not it's influencing people's behavior. So the big one here is, are people driving to New Hampshire to buy things? If they do drive to New Hampshire to buy things, they are subject to the use tax, but just thinking through those things. And the tax neutrality for meals and rooms, we definitely moved forward with that when the changes happened with some of the online travel agencies remitting meals and rooms tax, making it more neutral across all of those places. Accountability, this is just, you've heard about the tax expenditure report, 300 million sales and use tax expenditures in 2021, about 10 million of meals and rooms in also in 2021. And then the last chart, which you can look at on your own time if you want, is just, this is the estimated sales and use tax exemptions. The majority, about a third of which are on the sales of food. And then the next 2 biggest ones are energy purchases, clothing and footwear, and medical products. And that's my quick overview of some of the sales tax pieces. But
Okay.
if you have questions, I'm happy to answer them, and I can do it now, or obviously you guys have places to go, so I can do it another time.
I think this was a good overview. This is just 101. Tomorrow we start getting into the nitty-gritty of possible ways to finance the childcare bill. And definitely the grant people suggested some changes in the consumption taxes, so we will take a look at everything, assuming that that bill is gonna make it through. Either that or family leave or both, and that everything will need some funding, so that should keep us busy. Okay, committee, thank you. Some of us need to run across the hall. And I think that's it. Thank you.